Welcome to Session 2 of the Financial Management Overview. In this session, we'll cover sections 6 through 9 in e-text. Basically, we'll be looking at what we described in Session 1 as cash flow financing. That is, the issuance of bonds and stock to raise cash to fund the operations of the firm. Bonds are a debt instrument issued by the corporation. That is, it's similar to a loan. It borrows cash from the investor, pays it interest, and at some stated maturity date pays back the bond. On the other hand, stocks or sale of equity, that is a sale of a ownership share in the corporation, and there is no maturity date and there is no obligation on the part of the corporation to redeem stocks. Let's look first at bonds. Now, many years ago, before electronic data was used to store financial information, when an investor bought a bond, they would be issued a fancy certificate, such as the one you see here. And on the face of that certificate was the denomination. You might note it says $1,000. Well, because that denomination was printed on the face of the certificate, it was termed the face value of the bond. And for various reasons, that terminology is carried over to today. We still call the denomination of the bond the face value. Now, when it was time to collect interest from the corporation for the investor, what the investor did was go down to the bottom of the certificate, and there were a series of coupons. They would clip off a coupon and mail it to the corporation, and the corporation in return would mail them the interest payment. Now, on the face of those coupons was the interest rate paid on the bond. And for that reason, we call it the coupon rate. And again, that terminology is persisted today. We still call the interest rate on the bond the coupon rate. Let's look at the legal provisions of a bond. They are cited in what's called the indenture. The indenture is the legal contract. First, there is the face value. That is the dollar amount of the corporate debt to investors. In the United States, usually it's a $1,000 denomination. In fact, almost exclusively a $1,000 denomination. Next is the coupon rate. The coupon rate is the percent used to calculate annual interest payments to the investor. In other words, if you multiply the coupon rate times the face value, you'll get the annual interest payment. So if the coupon rate happened to be 5% and the face value $1,000, the corporation would pay $50 in interest to the investor each year. Next, there are the interest payment dates. Those are a schedule of days for the interest payments to be made. These are usually made semi-annually. So in the case of our 5% bond that paid $50 of interest per year, that would actually be split into two pieces, and the corporation would pay $25 on the first semi-annual payment date and the next $25 on the next semi-annual payment date. Finally, there's a maturity date. That's the date at which the bond matures and the face value is repaid to the investor. Now, all of these are fixed legal obligations of the corporation that must be met to avoid bankruptcy. Now, one thing that's not there is the price. The price of a bond is not fixed by the legal agreement. The bond's price is set by supply and demand in financial markets as investors buy and sell the bonds. Now, bond valuation is simply a time value of money problem. The value of a bond, the market value of the bond or the price, is the present value of a series of interest payments received plus the present value of the return of principal at maturity. We add those two together and we get the value or the price of the bond. So let's look at a bond from the point of view of cash flows for the investor. So over on the left, the red bar indicates that the investor must send $1,000 to the corporation in order to purchase the bond. Then, in return, they get a series of coupon payments over the years. That is, the interest payments on the bond. And finally, at the maturity date, the face value of the bond is repaid to the investor. Now, the key to all this is to evaluate, do all of these green cash inflows adequately compensate the investor for the cash outflow at time 0. Now, we can't just simply add them all up. It's a time value problem. And what we have to do is convert these future cash flows into present values. If you recall from our previous session when we were talking about the time value of money, we said if we want to determine the present value, we take the future value and divide by 1 plus the interest rate. And that way, the interest rate translates future value into present value. So for this first coupon payment, we would divide by 1 plus the interest rate, and we get the present value. The second coupon payment, well, it's 2 periods out, so we have to divide by 1 plus the interest rate 2 times. The third payment, we've got to divide by the interest rate 3 times, and so forth. Now, if this was a 5-year semi-annual pay bond, we would actually be dividing by 1 plus the interest rate some 10 times. Well, that's not the way we want to approach this. We would like a little bit more automated approach. And that's why we have a robot, that is the TI calculator. So on the calculator, you have 5 white financial function keys that are very important because they will help you solve very easily very complicated problems if you do it step by step by step. So let's look at them. PV, the PV key represents this red bar, this cash outflow, the cash that the investor sends to the corporation to purchase the bond. The PMT keys, those are the coupon interest payments made every, whatever the periodicity is. FV, that's the face value of the bond that's returned at maturity. The IY key, that's that interest rate that we're dividing by or using to divide. And finally, N is the number of periods. So let's look at a typical bond valuation problem. Let's suppose we want to determine the value of a 5-year, 4% coupon, semi-annual pay bond at a 6% yield. So first thing, let's figure out what all those keys, the white keys, how do we define them? Now, N is a number of periods, and since we have 5 years and we have 2 payments per year, we'll multiply 5 times 2, we get 10, and 10 will be the value of N. Now, this column here are the exact calculated keystrokes you follow in order to solve the problem. You type in 10, then you hit the N button. Next, the periodic interest rate, IY. It's 6% divided by 2 equals 3%. Every time you see a yield or a coupon in a question, they're always expressed as annual rates. So in this case, if we want to get the semi-annual yield, we have to divide by 2. So we take the 6% yield, divide by 2, and we get 3 is IY. Next, payments. We know the payments are the coupon rate multiplied by the face value. But again, that coupon rate is the annual rate, and we have a semi-annual pay bond. So we have to take that $40, divide by 2 to get 20. 20 is our payment. Next, face value. You'll notice face value is not given in this question. Anytime the face value is not given in a question, assume it's $1,000. So 1,000 is face value. And what's left over? PV, price. We don't know what it is. We've got to solve for it. We hit the CPT button, then PV, and we'll get a price of $915. Now, all bond problems are exactly the same. You're going to use all 5 white keys. The question will provide inputs 4, and you must solve for the 5th. It doesn't make any difference what order you enter these first 4 items. You could put face value first and the number of periods last. It makes no difference. But one thing you have to be always careful about. Now, face value and present value, we never have to adjust it. But these 3, N, IY, and payment, if it's not annual, you have to adjust it. Now, if it happens to be an annual pay bond, then you don't have to make those adjustments. Now, we show here that it's a negative number. Just ignore that. It's just the way the calculator is set up. We were talking about really a positive price, or we could interpret it as that's that red bar. That's the cash going out the door. Again, all bond problems are exactly the same thing. You're going to use all 5 white keys. You're going to input the 4 you're given in any order and solve for the one you're not given. Now, there's just one twist. Suppose we are given the price and we have to solve for yield. So our inputs are pretty much the same. 10 is still in. We're given a price of 900, so PV, and then we put in 900. We then have to hit the plus minus key to turn that 900 into a negative number, and then hit PV. Remember, the PV, or the price, that's money going out the door in order to pay for the bond. The payments are still 20. Face value is still 1,000. I'm going to compute IY, and I'll get 3.18. Now, N is the number of semi-annual periods. PMT is the size of the payment per semi-annual period. And likewise, at 3.18, that is the yield per semi-annual period. But just as in the question, coupons and yields are expressed as annual rates, if you're requested to solve for one, you need to use the annual rate as your answer. So you need to take that semi-annual rate, multiply by 2 to get the annual rate. Now, if you run into on your calculator something that says error number 5, it's simply you forgot to enter this PV as a negative number. So again, all bonds are exactly the same. It's just a matter of using those 5 white keys, picking the appropriate number in, and computing for the one that's not given. Now, let's talk about what happens if we change the yield assumption. So far, we picked arbitrary yield and arbitrary prices to illustrate how to solve a valuation problem. Well, let's look at this case where we have a 5-year, 4% coupon, semi-annual pay bond, and we assume a 6% yield. If we go through and do the calculation, we'll find out the price is $915. Well, what if I assume 7% yield rather than 6%? If I do, and I compute the present value of the price, I get $875. Very important, there is an inverse relationship between price and yield. If we reduce the yield, the price goes up. If we reduce the price, the yield goes up. It's always an inverse relationship between the two. That's very important, and that'll keep arising in different ways throughout this course. Always this inverse relationship between price and yield. Another item, and again, this is really a concept question. Don't worry about the calculations. It's something we call duration. So if we ask the question, what if interest rates rise by 1%? We start off, if we have a 5-year bond and a 4% coupon, if interest rates rise by 1%, the price of the bond will drop by 4.4%. In other words, it's what we call a duration of 4.4. Again, that inverse relationship between prices and yields. We assumed a higher yield, the price drops by 4.4%. With a 10-year bond, the price will drop by 7.8%, or we refer to that as a duration of 7.8. So duration is just the percentage drop in price caused by a 1% increase in the yield. So it's a measure of the intensity of that inverse relationship. You'll notice the long-term bond has a larger duration than the shorter-term bond. So duration increases with the term to maturity. And what that means is long-term bonds exhibit greater fluctuations in their price than do short-term bonds. So duration measures what we call market risk of a bond. Market risk being the risk that the price fluctuates a lot. So if you had like a 1-year bond, the price may fluctuate, probably no more from 1%. But if you have a 30-year bond, it could swing quite a bit. So if we say the 10-year bond has a duration of 7.8, if we had a 2% rise in interest rates, the price would drop by twice that much. So let's look at those two relationships graphically. The red line represents a 10-year bond, the blue line a 3-year bond. So as you'll notice that looking at the blue bond, if we assumed a 1% yield, the price is about 120. But as we assume higher and higher yields along the horizontal axis, we get lower and lower prices. So the downward slope of those two lines represents that inverse relationship. Now, you'll notice the red line is a lot steeper than the blue line. At a 1% yield, the red line had a price of about 150, but notice it falls off much, much more rapidly than the 3-year bond. So the steepness of the line illustrates the duration of the bond. Okay, let's look at the coupon rate versus the bond yield. Now, you'll run into this on the OA in various different contexts. So very important, let's start off in the middle. Par price. By par price, we mean the price of the bond is equal to the face value. So we're saying face value is always $1,000, so par price is the price of 1,000. At a par price, the yield of the bond is equal to the coupon rate. The coupon rate's 5%, par price, the yield is 5%. Now, what happens if we increase the price? We increase the price so it's a premium price. Let's say we just assume the price increased from 1,000 up to 1,100. Well, the coupon rate cannot change. Remember, it's in the indenture. It's fixed, a legal provision that's fixed. So the price goes up, the yield goes down. So now the yield is less than the coupon rate. That price increase in the bond lowers the bond yield. Look at it in the other direction. Suppose the price decreases from par down to a discount price, let's just say 900. As the price is going down, the yield is increasing. That bond price drop increases the bond yield. Now the yield is greater than the coupon rate. So far we've just picked artificially selected yields and prices, and we changed them just to see what happened to illustrate, yes, we're going to have an inverse relationship between prices and yields on a bond. Well, let's talk about why might the bond price change. Fundamentally, it's to adjust to the supply and demand in the marketplace. Now, the market yield is that yield determined by supply and demand in the market because of trading by buyers and sellers. Now, usually you're probably used to hearing that supply and demand determines price. And when we talk about stocks, we do talk about supply and demand determining the price of a share of stock. Well, the difference is with stocks, every share of stock is identical. If a company has 10 million shares of stock outstanding and you want to buy one share, it doesn't make any difference whether you buy share number 1 or share number 10 million. They're all the same. So you can apply a price and it'll be applicable to any one of those 10 million shares. Now, bonds are quite different. When a corporation uses bond financing, they don't have just one bond that's all the same. They may have 100 different bonds, and each of those bonds may have a different coupon rate, a different maturity date, different interest payment dates. So there's no such thing as the bond. If you go to buy, say, a bond from General Motors, you have to specify which bond. So that's why bonds trade on a yield basis. Let's suppose that you wanted to buy a bond, a 5-year bond from some corporation. There might be a dozen bonds that cluster around 5 years. Some of them might be 4 years and 10 months maturity. One might be 5 years and 1 month. They might have different coupon rates. So all of those are fairly interchangeable in the eyes of the investor. And the investor might say, okay, I think these bonds should yield 6%. So any of that cluster of bonds, let's say there are 10 bonds, all of those bonds that cluster around 5 years will trade for a yield of 6%. Now, because their terms are slightly different, though, they'll have slightly different prices. So there'll be 10 different prices reflecting the different terms. So that's why bonds trade on a yield basis rather than a price basis. So why must the yield on a particular bond equal this market yield? Well, if you set the price on your bond at a yield that's too low, there'd be no buyers. They'd say your price is too high. We can go out and buy other bonds for a lower price. What if the bond yield is too high? Well, then there are no sellers. So the yield on a particular bond has to equal that market yield, the market yield determined by investor trading in financial markets. That is the only way a particular bond can be the subject of a trade execution. You have to have the buyers and the sellers both agree that it's appropriate yield. So supply and demand forces any bond's yield to equal that market yield. What affects a bond's required yield? Well, one thing is Treasury security yields. Corporate bonds generally trade at a spread over Treasury. That is, United States Treasury securities are absolutely risk-free, but private corporations may go bankrupt, so there is risk. So typically, investors make a judgment about the riskiness of the corporate bond, and therefore determine a spread that's adequate compensation for that risk. For instance, if Treasury yields are 3% and a particular bond and investors have decided that it should have 1% higher yield, that corporate bond would trade for a yield of 4%. Well, what happens is developments in the economy are such that Treasury yields increase to 3.5%. Well, in that case, the price of that corporate bond would have to drop until it reaches a yield of 4.5%, maintaining that 1 percentage point yield spread over Treasury. And again, that spread just reflects the investor's judgment as to the riskiness of the corporate bond versus risk-free treasuries. So generally, risk plays a role. The rating agencies rate all publicly traded bonds. AAA bonds are the safest bonds, so they have lower yields than, say, BBB bonds, which are higher risk category. So riskiness depends upon the rating from a rating agency. And from time to time, rating agencies might downgrade a bond. That is, the bond might have a AAA rating, but agencies reassess the riskiness of the bond and decide it should be a single A. In that case, that would force a decline in price in the market in order to raise the yield to compensate for that higher risk assessment. Next, the term of the bond. Long-term bonds tend to have higher yields than short-term bonds. There are a couple of reasons. One is credit risk. If you have a one-year bond from a corporation, there's not much chance that the corporation is going bankrupt. However, if you have a 30-year bond, there's ample opportunity for the corporation to go bankrupt. So there's more credit risk in a long-term bond. Also, as we talked about a few minutes ago, there's market risk. Long-term bonds, their prices fluctuate more over time than short-term bonds. So both credit risk and market risk lead to long-term bonds tending to have higher yields than short-term. Next is collateral. A collateralized bond or a secured bond has lower yields due to less risk. That is, the corporation pledges certain assets to back the bond. In the event that the corporation goes bankrupt, the investor can seize that collateral and sell it to get their principal back. Finally, taxes. The tax-exempt bonds have lower yields, and there's two categories. Municipal bonds are exempt from federal tax. There is one exception, private activity bonds, which are the situation where a local government might say purchase land to help build a factory for a new company as an inducement for them to relocate. And in that case, it would be subject to the alternative minimum tax. Next, federal bonds are exempt from state tax, and that's true generally of all U.S. Treasury securities. However, Fannie and Freddie, the two government-sponsored agencies, their interest is not exempt. Okay, how do we actually trade bonds in the real world? As you might guess, investors don't sit around with their TI calculator to calculate the price and yield of bonds. What they use is something called Bloomberg. And if the name sounds familiar, Michael Bloomberg, the former mayor of New York City, became a billionaire by founding the Bloomberg Company. And what this is, it's a giant database of all public securities and a variety of analytical models. For instance, you see one of the screens from Bloomberg depicted here. And up here at the upper left-hand corner, if you just enter the characteristics of the bond you want to analyze, then the rest of the table populates. So in this case, XOM, it's an ExxonMobil bond. The coupon is 6 3/4. Maturity date, August 1, 2037. And it's a corporate bond as opposed to not being, say, a government bond. Down here, you'll see yield, price, spread. Now, you just put in the descriptor of the bond. This will automatically populate at the computer system's estimate of what the price and yield should be. But you can change either one. You can change the yield, and it'll solve for the price and spread. You can input the price, and it'll solve for spread and yield, or you can input a spread. And that's the spread versus this treasury security right here. Now, in financial markets, we actually call par price 100 as opposed to 1,000. In the textbook case, in this course, we're using 1,000. In reality, 100. Everything's based on a par price of 100. And then finally, over here to the right, you see the duration of this bond. It's 13.4. And that's a very important measure for investors. So this is realistically how investors buy and sell bonds. And this is a very widespread computer system found in financial firms all around the world. Now, this next area actually shouldn't be part of the course. This course is supposed to be about corporation finance. But APR and APY is really consumer finance issue. But it's part of the course, part of the text. Will probably be part of the OA, so we're covering it. So what is APR? APR is the quoted annual rate. It's like analogous to the coupon rate on a bond. APY is the effective yield that takes into account whether the interest payments are made annually, semi-annually, quarterly, monthly, or daily. It's a stock formula. APY is just simply 1 plus APR divided by the number of periods raised to the power of that number of periods. Well, let's look at an example. Suppose we have 6% APR and it's semi-annual, so there are 2 payments per year. So the formula would tell us, we would say 1 plus 0.06 divided by 2 raised to the second power minus 1 gives us 6.09%. Now, what are the actual keystrokes you're going to use? Okay, first thing you'll enter in the calculator is 1.03. That is 1 plus 0.06 divided by 2. So 1.03. Then you hit the Y to the X key, which is right above the 9. You enter 2, hit the equal sign. The answer will pop up as 1.0609. You hit minus 1 equal 0.0609. So the exact keys that strokes you want to follow. Now, why do you come up with a higher number? Well, let's look at this. If you start off at day 1, you have $100, and at the end of the first semi-annual period, you're going to pay 3% interest. So the total amount is 1.03. Then for the second half of the year, we start off with a principal amount of 103, and again we multiply by 1 plus the interest rate, 1.03. We get 106 and 0.09 cents. Okay, so the concept of this is the more compounding periods they are, the higher the yield. That's the concept to remember. And calculation-wise, just be able to go through those keystrokes to solve what the APR is. Now, it may be semi-annual payments, maybe quarterly, maybe monthly, maybe daily. So whatever the number of periods are, that's what you divide by, and that's the power you raise it to. Now, another related problem to APR, APY, is the amortizing loan problem. Suppose a person obtains a $1,000 1-year monthly amortizing loan with an APR of 7%. So, question might be, what's the monthly payment? Well, we use the 5 white keys. We can just pretend it's a bond. $1,000 is PV. In this case, it will remain positive. N is 12 months. The interest rate, well, again, 7%, that's the annual rate, so we have to divide by 12. We get 0.5833, and that's IY. It's amortizing. Okay, so the face value is 0. Like with the auto loan, when you make that last payment, that's it. Your loan balance is down to 0. And compute payment, you get $86.53. And like bonds, they could give you any 4, and then you solve for the other one. For instance, they might give you the payment and ask you to solve for the present value. Another way to look at it is how much interest is paid. Well, if we're going to make 12 payments of $86.53 each, our total payments are $1,038.36. The loans for $1,000, that's the principal we repaid, so the interest paid is $38.36. One other variation is the, quote, simple interest problem. Person invests $1,000 at a simple interest rate of 5%. How much interest would be earned after 2 years and 6 months? Well, first of all, always look for the word simple interest. If it's not in there, you don't use this formula. It's only for simple interest. And it's pretty straightforward. Principal times interest rate times year. At a $1,000 principal, interest rate was 0.05. 2 years and 6 months, that's 2.5 years. So we get $125. Next, let's move to stock valuation. There are certain legal provisions of stock. There are actually 2 types of stock, common stock and preferred stock. Now, common stock is an outright sale of the ownership of an ownership stake in the corporation. In effect, each share of stock is ownership of the earnings per share. And the stockholders receive dividends, but purely at the discretion of the corporation. And the corporation is under no obligation to actually pay dividends. But the owners do have voting rights to elect the board of directors for the corporation. And there is no maturity date. That is, there's no date at which the corporation is obligated to redeem the stock. Now, preferred stock is sort of a hybrid between bonds and common stock. And like common stock, it has no maturity date, but it has no voting rights. It has a mandatory fixed dividend. That is, the corporation must pay the preferred dividend before they could pay any common dividends. But it's a fixed dollar amount. And it has priority of claims over the common stock in bankruptcy. Now, preferred has that fixed dividend, say it's $100 a year. Common stock, while there's no obligation on the part of the corporation to pay dividends, it's ordinarily expected that dividends will increase over time because as the corporation grows, gets more profitable and expands and has greater and greater profits, the board of directors are likely to charge or pay increasing dividends over time. Let's look at how to calculate the actual return to stock investors. There are 2 sources of return, dividends and a capital gain or loss. Well, dividends, those are just actual checks that the board of directors vote on and approve, and they're sent to the investor. There's also whether you have a capital gain or a loss, and that is simply the sales price minus the purchase price. So let's look at an example. An investor buys a stock for $20, receives a $1 dividend, and sells for $25 after a year. What is the return? Well, the two sources of return, dividend, it's $1. The capital gain, they sold it for $25, they bought it for $20, they had a $5 gain. So we have two sources of profit, the dividend, the capital gain. So a total of $6. What was our investment? Well, we invested $20 to buy the stock. So 6 divided by 20 gives us a 30% return on our investment. So let's look at what determines the value, the market value of a share of stock. Now it's very analogous to bonds. With bonds, we said that the value of the bond was the present value of the interest payments plus the present value of return of principal at maturity. We add those together, we get the value of the bond. Stock is analogous. Stockholders don't get interest payment, but they get dividend payments. So it's the present value of the forecasted dividends. And there's no return at maturity, but stock investors don't hold the stock forever. At the future, when they sell the stock, they get cash coming in. That's analogous to the return of principal at maturity. And we add those two together, we get the value of the stock. So really, all financial instruments, stocks, bonds, anything, they're all a present value problem. That's why we were looking at time value of money in the previous session. Now, there are three analytical frameworks for valuing stock. The first one is something called the single holding period stock value, and that's where the dividend is a constant number, it doesn't change. Second, there's the Gordon growth model, and that's the case where you assume that the dividend grows over time. It's increasing. Each year, the dividend is a higher number. And third, the capital asset pricing model, and this determines the right discount rate we want to use in solving that present value problem. Let's look at a stock value single holding period problem. And this one says, what is the value of the stock that has a $2 dividend, a $90 price in 1 year, and a 12% yield? Now, when you get into single holding period, down here in the lower left, that's the formula that they give you on the sidebar, and that's exactly what it looks like. And they don't define the letters. They don't define the subscripts. Now, I would recommend strongly you just totally ignore that formula, because with single holding period problems, you can use the 5 white keys, pretend it's a bond. So first of all, how do you identify a single holding period? You look for 1 year in the question. If you see 1 year, that's that single holding period. So how do we do this? We're going to use the 5 white keys. So N is the number of periods, 1 year. So 1 is N. You're given the yield, so 12 is IY. Dividend, that's the payment, so $2 is PMT. What about the future value? That's that $90 that you're going to sell it for in a year. And let's compute PV, and we find the price is $82.14. Now, another good reason for using the white keys, the financial function keys, is that this formula, given on the sidebar, only works for 1 year. Using the financial function keys, you can have any number of periods. You could have 5 years, and you can still use it. Let's look at one more example. Stock is bought for $85, has a dividend of $2, and will sell for a $90 price in 1 year. What is the yield? So again, like bonds, you'll be given 4 items and you solve for the 5th. And again, it doesn't make any difference what order you enter these in your calculator. But we still have number of periods, it's 1. The price, We bought it for $85, so it's 85. Remember, anytime we're entering a present value for a bond, it should be a negative. So 85, hit the plus minus key in PV. 2 is payment. 90 is the future value. And then I'm going to compute IY, and I get 8.23%. Second, we have the Gordon growth model. And what that does is assume that the dividend is not constant, but it grows over time. Let's say it grows 5% a year. Now, in the lower left-hand corner are the sidebar formulas. And unfortunately, that's exactly what you get. And they don't define what the letters are. They don't define what the subscripts mean. So you'd have to just memorize all that. Well, I would recommend while you're memorizing, let's just memorize the words. The words are a lot easier to remember than a bunch of letters and subscripts. So the model is just simply the stock price is equal to the expected dividend, the dividend the investor expects to receive, divided by the required return, an interest rate, minus the growth rate. Now, you'll notice it's expected dividend. Now, if you are given in the question the last dividend, say the corporation just paid a dividend of $2 or recently paid a dividend of $3. That's not what we're looking for. We're looking for the next one. And so if you have that last dividend, you just multiply by 1 plus the growth rate. There's a second version of this formula. It's actually the same formula. All they did was they took the stock price and moved it from the left-hand side of the equal sign over here to the right. And they took required return and moved it from the right-hand side of the equal sign over here to the left. So that's the same formula, just rearranged. That is, the required return is equal to the expected dividend divided by the price plus the growth rate. Now, back when we were talking about time value of money, we call this a perpetual growth annuity. Let's look at problem number 1. If a stock recently paid a dividend of $2, has a required return of 12%, and dividends are expected to grow by 3%, what's the stock price? Well, first key is look for grow in the question. If you see the word grow or growth, that's the Gordon growth model. Now, second thing to be careful about is it expected to pay a dividend or is it recently paid? Well, it recently paid a $2 dividend. Well, what's the next dividend? Well, the next dividend is going to be 3% higher. That's what we're assuming. It increases by 3% a year. So we're going to take that $2 last dividend, multiplied by 1.03, so that we find out the next dividend will be $2.06. We're going to divide it by the required return of 12% minus the growth rate of 3. So we're dividing by 0.09. And we find out the price of the stock is $22.89. So always look for growth as the thing that defines it as Gordon growth model, and also be careful as to whether it is a recently or just paid dividend or the expected dividend. Now, remember we said there are 2 types of stock. There's common stock, in which the dividend can be expected to grow over time. But preferred stock, remember, has a fixed dividend. Well, we could solve this problem using the same formula, just that the growth rate of the dividend is 0. It would just simplify down to the expected dividend divided by the required return. Let's look at the other one. Suppose we're asked to solve for required return. Here, it's going to be the expected dividend divided by the price plus the growth rate. So if a stock is expected to pay a $2 dividend, has a price of 20, and dividends are expected to grow by 3%, what is the required rate of return? Well, now we've got the expected dividend, so we don't have to adjust it. So it's just simply the $2 expected dividend divided by the price of 20, gives us 10%. Then we add 0.03, get the 13% required return. So as we get further on in the course, we're going to be using the PE, or the ratio of the share price to earnings per share. And so at this point, we can use the Gordon growth model to just illustrate what determines the PE of a company. So let's suppose that a company has an earnings per share of $2, a payout ratio of 100%, so the dividend's $2 too, and a required return of 12%. Now, if we assume that the growth rate of dividends is 4%, we'd have the $2 dividend divided by 12% minus 4%. We'd find that the price is 25, and take that 25, divide it by earnings per share of $2, we get a PE of 12.5. Now, let's increase our assumption to a growth rate of 7%. We'll have $2 divided by 12% minus 7%. We'd end up with a price of 40, and the 40 divided by the $2 earnings per share gives us a PE ratio of 20. So the PE reflects primarily investors' expectation of the growth rate of earnings and dividends. Now, sometimes you hear people on TV say the stock is too expensive because it has a high PE, or it's very, very cheap because it has a low PE. The PE does not indicate whether a stock is expensive or cheap. What PE reflects is just investors' expectation of the growth rate of earnings and dividends. When you get later on into the valuation of a private company, you'll be using this PE as a key metric to value the private company. The third item, or third analytical model, is capital asset pricing model, or CAPM. And so far, when we are talking about valuations of stock using, say, the Gordon growth model, we're just given a required return. It's 12% or it's 10%. Well, the capital asset pricing model is a way of determining what that required return is. So let's start off first with the definition of market risk premium, equal to the market return minus the risk-free rate. Well, the market return is just investors' expectation of the yield they'll earn holding a portfolio of stocks. For instance, just to pick a number out of the air, let's assume that they expect that they have a portfolio of stocks that pretty much replicates the S&P 500, that they will earn 13% yield per year. That's what market return is. Risk-free rate is just the rate on U.S. Treasury securities. That is, U.S. Treasuries are risk-free in the sense that there's no credit risk. So just to pick a number out of the air, let's say it's 3% is the risk-free rate. So what's the market risk premium? 13 minus 3 gives us a market risk premium of 10%. So that's the average on market risk premium for stocks in general. What does that mean? Well, stocks are a lot riskier than Treasury securities. So in order to induce investors to hold stock, they have to expect that they're going to earn a higher yield. In this case, the expectation is that they will earn a 10 percentage points higher yield holding stocks than just simply holding treasuries. So what we're really saying then, the required return, and by required return, I mean the same thing as market return. Market return, required return, same thing. What is it? It's the risk-free rate plus the market risk premium. But we've added this one other term, something called beta. Beta is an index of the relative riskiness of individual stock. Now, by definition, beta equals 1.0 for stocks in the S&P 500 on average. So the average beta of 500 stocks in the S&P 500 index is 1.0. Now, so that means the average stock, what's the required return? 3% plus 1 times 10% market risk premium. So it's 13%. Now, a company might be riskier than normal. Let's say the company has a beta of 1.5. If that is so, it's 50% riskier than the average stock. You multiply 1.5 times that market risk premium of 10%, it would have a market risk premium of 15%. So it'd have 15% plus the 3% required return would be 18% on that risky stock. On the other hand, some stocks are safer. Suppose it has a beta of 0.5. So 0.5 times this, instead of a market risk premium of 10%, it'd only be 5%. So you'd have a 5% market risk premium plus the 3% treasury rate. The required return on that safe stock would only be 8%. Now, the key to this is simply we want to identify the required return for a specific stock. And that's what beta allows us to do, define the riskiness and therefore the market risk premium for a specific stock. And overall, just the higher the risk, the higher required return. Same thing with bonds, same thing with stocks. If there's more risk, investors have to be rewarded with a higher return to compensate for that risk. Now, the sidebar formula given for this is actually pretty good. I mean, it is in letters and subscripts, but they do define what they are. They do define them. So you can do this or just remember this, whichever works best for you. So let's look at what a high beta and low beta stock looks like. On the left, this blue line represents fluctuations in the level of the S&P 500 over time. It's up, it's down, but generally increasing over time. A low beta stock is one that moves along with the S&P 500, but it fluctuates less. The price is more stable than the market on average. A high beta stock, though, is like this red line. You notice it is fluctuating a lot more than the blue line representing the S&P 500. So when you buy a high beta stock, you don't know whether you're buying here at the point, the peak, and soon you're going to lose a lot of money when the stock price drops down to here. Or it could be that you're buying down here at the bottom and the price is getting ready to take off and you're going to make a lot. So there's a lot more volatility. So high beta stocks, the price just fluctuates a lot more than the S&P 500. Now, if you wanted to know, statistically, what is this beta? Well, it's the standard deviation. You take prices of the S&P 500 over time, say the price is daily price for the last year, you get the standard deviation of those price fluctuations. And do the same thing for an individual stock. And so you just get the standard deviation of the price fluctuations in a particular stock and divide it by that for the S&P 500. That's what beta is. But you don't have to worry about that. That's beyond the scope of the course. You won't have a calculation problem with that. Let's look at an example. And here we want to look for beta in the question. We see that word beta, we know it's capital asset pricing model. So if the Apney Corporation has a beta of 1.5, the market return is 12%, the treasury rate is 3, what is the required return? We just fill in the formula, 3% risk-free rate plus beta multiplied by the market return minus the risk-free rate. Now, just be careful in doing the calculations. First of all, you do the calculation inside the parentheses. So you have the 12% minus 3% gives you 9%. Then you multiply by 1.5, which gets you up to 13.5%. Then you add the 3% to get you up to 16.5. So just make sure you're doing the order of operations correctly. Again, what are we talking about? Risky firms have a higher market risk premium and require higher yields. Okay, so we've talked about single holding period, we've talked about Gordon growth model, we've talked about now capital asset pricing model. Well, what do investors actually do? Well, let's start off with the Gordon model has a couple of flaws. One, we have to project the dividend growth rate forever. And forever really is a pretty long time. Nobody can do that. And then the other one is, well, what do you do about firms that do not pay dividends? Well, part of that is worth zero, but there are an awful lot of firms out there that don't pay dividends. So what is the solution? Well, when you talk about sophisticated analysts, people like working for JP Morgan or Goldman Sachs or Standard & Poor's, Morningstar, any of these, it's a pretty common approach. Well, first of all, they just look at the earnings per share growth rate, and they do it for, say, the next 5 years. Pretty typical 5 years. And what they do is they do a complete analysis of the company. They think about, the product, what kind of competition, what do they expect to happen. So they feel like, well, it's not going to be perfect, but I can come up with a reasonable estimate of the growth rate of earnings per share for the next 5 years. So it might be, we project 12% growth rate for the next 5 years. Well, what do you do after 5 years? Well, you just have to pick up a common assumption. Now, if you look at the long-term growth rate of corporate profits in the S&P 500, say over the last 20 years, it averages about 5%. So most of these just assume after the first 5 years, it's just going to grow at 5% forever. So what do we end up with? The value of the stock, it's the present value of the projected earnings per share the first 5 years, plus the present value of a perpetual growth annuity after 5 years. In other words, the Gordon growth model with 5% growth rate. And what discount rate are we going to use? Again, we're going to the capital asset pricing model. We're going to use treasury rate plus beta times the market risk premium. So this is analysis they go through. Now, a couple of sections in the study guide, question 139 kind of alludes to this. And in the section 710 e-text, it kind of refer to a two-stage model, but they don't really, it's very skimpy discussion. It doesn't really tell you what's going on. But anyway, this is basically analysts approach this and they say, okay, this is what the stock should be. And this is intrinsic value. Remember, we introduced the concept of intrinsic value back very early on in the first session. Intrinsic value is what the market price should be. i.e., it's the present value of the expected cash flows. So how do we use intrinsic value? Okay, we've got two stocks. Which one should you buy? We've got Super Technology. Yeah, they've got a great product, dominant market share, very steady profitability. Or we'll have knockoff imports. Yeah, they import low price, kind of shoddy quality clothing. It's a pretty small company, small market share. Yeah, profitability, it's okay, but it's low. Which one would you buy? Well, if you listen to some of these people on TV, they'll go on and on about what stock you should buy. Well, it's always a super technology type stock. They have it's a great company, great product, blah, blah, blah. Well, fundamentally, there's no such thing as a good stock or a bad stock. There are good prices and there are bad prices. Now, Super Technology, its market price is 35, but its intrinsic value is 25. In other words, fundamentally, it should be worth only 25, but if you want to buy a share, you're going to have to pay 35 for it. That doesn't sound good. Knockoff import, yeah, doesn't sound very fancy, but its intrinsic value is 12. It's less than half Super Technology, but its market price is 6. So a couple easy rules. The market price is less than intrinsic value, you want to buy. You're getting it cheap. The market price is greater than intrinsic value. You do not buy, you want to sell. So which stock? Well, knockoff imports, that's the good buy. Super Technology, you're destined to lose money, regardless of how great a product it was. So if you listen to TV, stock prices fluctuate every day. Well, why do stock prices fluctuate? One item is the risk-free rate. Remember, we say the required return on stock is the risk-free rate plus the market risk premium, and treasury interest rates change. So if that change, the required return on a stock changes. And remember, if you change the required yield, then the price is going to move in the opposite direction. Remember, just like bonds, there's an inverse relationship between yield and price. They fluctuate in opposite directions. So if we change the required yield because of the change in treasury rates, then the prices are going to change. Next, earnings per share. Quite often, investors change their expectations of a firm's profit growth, and that will affect the price. The risk premium, well, not always to the, well, in other words, the risk premium is not a fixed number necessarily, and it varies. If from time to time, investors in the marketplace tend to be overly optimistic, and the risk premium drops. And in some cases, they get really pessimistic. They think the economy is going to a recession, and that risk premium rises. So it could be just changes in investors' perceived riskiness of stock, that's what the risk premium is compensation for. Beta, a firm's beta is not necessarily fixed. It can change from a variety of reasons. And finally, there are event risks, just particular things that might happen to one firm. For instance, a drug company's, best-selling, most profitable drug is taken off the market by the FDA. That would really impact its stock. So basically, daily economic, political, international events impact these factors. And basically, they're just saying it changes. Uh, there are fluctuations in investors' estimate of the intrinsic value of a stock. Okay, what do investors try to do? Well, we're going to look at several graphs. This first one is a quadrant graph. And basically, an investor wants to, for whatever risk they take, they want to maximize their return. So if we have this quadrant graph, we have 5 different alternatives, A, B, C, D, and E. Let's first of all find out which is the absolute best. Well, A and B have the highest expected return, so they're tied for that. But B has a lot more risk. So A has the highest ratio of return to risk of any of these. So A is the absolute best. Well, what's the worst? Well, D and E have the lowest expected returns, but E has a lot more risk than D. So E is the absolute worst. It has the lowest ratio of return to risk. Next, let's talk about diversification and the fact that it eliminates what's called idiosyncratic risk. Idiosyncratic risk is events that impact only a single firm. For instance, fire destroys a factory. That's idiosyncratic risk. If you only had one stock and the fire destroyed its factory, you would take a big loss on your investment. The value of that stock would go down. But if you diversify, suppose you had 100 stocks, well, the fire might drop the value of that one share, but it would not impact the other 99, so you'd have much less risk. So that's idiosyncratic risk. It can be eliminated by diversifying, holding a lot of different stocks. Now, as in contrast to idiosyncratic risk, is systematic risk. And that is risk that impacts all firms. For instance, the economy goes into a recession. Now, if the economy goes in recession, it impacts all firms, not equally. For instance, auto manufacturers would be impacted significantly because auto sales tend to decline quite a bit in a recession. On the other hand, grocery chains are not impacted that much. People are going to eat whether it's in a recession or not. So systematic risk you can't get rid of. Now, the key is that because you can diversify and get rid of idiosyncratic risk, investors are not rewarded for taking this risk. But since you can't get rid of this systematic risk, that's where the market premium return comes into play. In other words, when we think about that capital asset pricing model, we're talking about the market risk premium. That market risk premium is compensation for investors being subjected to systematic risk. They can't get rid of it. They have to be compensated by the market in order for them to take on that risk. Next is the efficient frontier. And the efficient frontier basically says it is the types of portfolios that have been diversified sufficiently that they have no idiosyncratic risk. So any portfolio that's on this line is one that is properly diversified and it has no idiosyncratic risk. And so therefore, it's an optimal combination of risk and return. Any dot below that is an inferior portfolio. It has not been diversified enough to get rid of idiosyncratic risk, and therefore its ratio of return to risk is suboptimal. They've got a bunch of risk in their portfolio that they're not getting compensated for. So every investor has different tolerance for risk. Along this horizontal axis, we have a measure of risk, low risk to the left, high risk to the right, and up and down on the vertical axis is that required return or expected return. Well, if we have an investor that's very, very conservative, they hate risk, they want something very, very safe, well, they would be down at this end of the risk spectrum, low risk. Given that, they would go up until they hit the efficient frontier, and that gives them the maximum ratio of expected return to risk given their risk preferences. So what kind of investor is that? That investor might have a portfolio of low beta stocks, real safe stocks. On the other hand, some investors are more tolerant of risk. They might say, well, I'm willing to take on a lot more risk because I want to make some big returns. So they might move out to the high risk side. And then they would have a portfolio, if they properly diversify it, they get up to the efficient frontier, and they're having the optimal combination or the optimal ratio of expected return to risk. Because they're taking on a lot more risk, they have a much higher return than the investor that's highly risk averse. Now, this investor might have a portfolio of high beta stocks. Next, let's look at how do we determine the expected return on a stock. Now, this will be the first of three frameworks that use what I'll call a weighted average. And it's very important that you follow these steps because it's going to make a solution to a difficult problem easy. So first of all, let's suppose we have a stock and we think, well, if things go along as usual, I'll earn a 7% return. And I think there's a 50% probability of that. But, there's a 20% probability that the economy will go into recession, and I'll only earn 2%. And there's a 30% chance the economy will take off in a boom and I'll earn 12%. So I want to know what's my expected return. Well, your expected return will be a weighted average of these three returns using the probabilities as weights. For instance, we'd say 20% times 2% plus the 50% times the 7% plus 30% times 12%, and we get 7.5%. That's our expected return on this particular stock. It is simply a weighted average. Note, the sum of the probabilities have to be 100%. Now, they do give you this formula in the sidebar, but I would recommend just remember that it's simply sum of probability times return plus probability times return plus probability times return. Just a weighted average using those probabilities. And you'll see why in a minute, why we recommend that approach. Okay, that's a single stock. Let's look at the expected return on a portfolio. Let's say we have stock A, we have 5 million, and we found out it had an expected return of 7%. Stock B, 15 million, and it had an expected return of 12%. Now, if we had equal amounts of A and B in the portfolio, we'd just take an average of 7 and 12. That'd be simple, but they're different amounts. So first step is, what is the proportion of stock A in the portfolio? Well, it's 5 million divided by 20, or 25%. Stock B, 15 million divided by 20 million, or 75%. And of course, proportions have to add up to 100%. So how am I going to determine the expected return on the portfolio? It's just the sum of proportion times return, proportion times return. So I'm going to say 25% times 7% plus 75% times 12%. I get 10.75 is my expected portfolio return. Again, it's what we call a weighted average. I'm getting a weighted average of these expected returns using the proportions as the weights. Before, I got a weighted average of expected returns using probabilities as weights. Now I'm using proportions as weights, but the arithmetic is the same, which leads to the weighted average cost of capital. Now, the reason I was emphasizing just thinking in terms of proportion times cost is in the lower left-hand corner, that's the formula they give to help you on the OA. And of course, they don't define what the terms are. So vast majority of people don't even bother to look at it. It doesn't mean anything to them. So you don't need it. You don't need it. Just like before, it's just the sum of proportion times cost, proportion times cost. We're going to have two types. We're going to have debt. We're going to have equity. It's just the proportion in debt times its cost plus the proportion in equity times its cost. Just remember, proportion times cost plus proportion times cost. Now, one slight difference, bond interest is tax deductible, so we have to multiply the debt cost by 1 minus the tax rate. Let's look at an example. A firm's debt is valued at $200 million, has a market yield of 6%, while the firm's equity has a market value of $300 million, an expected yield of 12%. What is it whack if the tax rate is 20%? Okay, we'll do just like we did for a portfolio. We want to focus on proportion times cost. So what's the proportion of debt? Well, we have 200 debt, 300 of stocks, so 200 divided by the total of 500. 40% of the funding comes from debt, and I know the rest has to be 60% because the proportions have to add up to 100%. So I'm going to do proportion times cost plus proportion times cost. So debt proportion is 40% times cost of 6%. And with debt, though, we need to multiply by that 1 minus the tax rate. And then for stock, 60% times the cost. So 60 times 12, this is 9.12. So again, if you just always remember the logic of proportion times cost plus proportion times cost, then you don't need that complicated formula they give you on the sidebar. Now, one twist, and if you've taken the pre-assessment, you've stumbled over this. If pre-tax is sought, you just don't multiply by 1 minus the tax rate. And what if instead of just stock, what if I said there was 100 in preferred stock and 200 in common stock? We just have 3 rows in our table. But again, it would be proportion times cost plus proportion times cost. So why do we calculate WACC? Well, fundamentally, it's the cost of financing the firm's operations. The firm sells stocks and bonds in order to raise cash to fund the production and sale of the product. So in any activity, you want to know what are your costs. Second is the hurdle rate for evaluating potential investments. Now, we'll get into that a lot more in the next session of the webinar. But if it costs you, say, 10% to raise cash to invest, you want to make sure that what you invested in is earning more than 10%. In other words, that's the hurdle rate. If your yield on investment is less than 10%, you're losing money. So you want to make sure the yield on your investment exceeds WACC. So it's the hurdle rate. And it impacts the firm's net income. So the interest expense on bonds is an interest expense that's deducted and reduces net income. So that's why we're calculating WACC. We're combining the market yield of debt and the required return on equity to give us an overall cost of what does it cost us to finance the operations of the firm. So what affects WACC? Well, several things. The proportions of debt and equity affect it. Debt is generally cheaper than equity. So if you have more debt and less equity, your WACC is lower. Well, but we'll find out that at some point, though, you could have excessive debt, and that would cause some problems. But generally, debt is cheaper than equity, so increasing debt would increase profitability. Next, riskiness of the firm. Risk will increase the cost of both debt and equity. Remember, we said that corporations trade at a yield spread over Treasury security, and that spread reflects investors' expectations of the riskiness of the corporation. So if they increase their risk assessment, the cost of debt goes up. Same thing with equity. The higher the risk of the company, the higher the required return. The tax rate. Actually, it's kind of counterintuitive, but the tax rate, if it increases, decreases debt cost. Think of it this way. If the tax rate is 20%, that means that the federal government is paying 20% of the interest cost and the corporation is paying 80%. If we increase the tax rate up to 40%, that means that the government is paying 40% of the cost and the corporation is only paying 60%. So for the corporation, their share of the interest expense would drop from 80% down to 60%. Next, higher interest rate levels. Higher interest rates increase both the cost of debt and equity. The debt, we said, corporate debt trades at the spread over Treasury securities. So if Treasury security yields go up, the cost of the debt goes up. Same thing with equity. Remember, we said that in the capital asset pricing model, the required return is the risk-free rate plus plus. So that would affect the cost of equity. And finally, the maturity of the debt. Long-term debt tends to be viewed as riskier. So if you have more long-term debt, then your WACC is tend to be higher. One final thing to remember always, though, when you do WACC, we're really basing it on market yields and values. We do not use accounting numbers because accounting numbers are reflecting what went on in the past. And that doesn't mean that you can continue to base your decisions on past numbers. So that's the end of session 2. At this time, I would say please complete that section 2 of the overview calculation quiz that will test your ability to solve some of these problems from scratch. And if you have any questions or suggestions, feel free to shoot me an email, or if you'd like, schedule a call with me for going over things in more detail. Thanks a lot for joining me today.